2025 is the year to take control of your financial future, and one of the simplest ways to do that is through index funds. But with so many options and comparisons, index funds versus ETFs, index funds versus mutual funds, how do you choose the best for your needs? In this video, we'll cover everything you need to know, including 5 top-performing index funds to invest in right now, and their dividends, benefits, and disadvantages. Let's get started. What are index funds? Index funds are mutual funds or ETFs that track a specific market index like the S&P 500, NASDAQ, or Dow Jones. These funds hold all the securities in the index, offering instant diversification at a low cost. Warren Buffett famously said, "A low-cost index fund is the most sensible equity investment for the great majority of investors." They're ideal for building wealth steadily without the stress of picking individual stocks. Benefits of index funds. Index funds offer several key benefits for investors. Low costs. Since they are passively managed, index funds have lower expense ratios compared to actively managed funds. Diversification. They provide instant exposure to a wide range of stocks or bonds within a specific index, reducing risk. Consistent returns. Index funds aim to match the market's performance, delivering steady long-term growth. Ease of use. Simple to understand and manage, making them ideal for beginners. Tax efficiency. Their lower turnover generates fewer taxable events, saving investors money. Disadvantages of index funds. Despite their benefits, index funds have some drawbacks. No outperformance. You only match, not beat, the market. Market risk. Fully exposed to downturns. Limited flexibility. Can't customize to exclude sectors or companies. These limitations mean index funds may not suit everyone, particularly active or high-risk investors. Index funds versus ETFs versus mutual funds. Investors often compare index funds, ETFs, and mutual funds to determine the best fit for their goals. Here's how they differ. Index funds. Definition: a type of mutual fund designed to replicate the performance of a specific market index. Management style: passively managed, leading to lower fees. Trading flexibility: trades only at the end-of-day market price. Cost: low expense ratios, typically lower than actively managed mutual funds. Best for long-term investors seeking simplicity and low costs. ETFs, exchange-traded funds. Definition: funds that track an index but are traded like stocks on an exchange. Management style: can be passive or active. Trading flexibility: trades throughout the day at real-time market prices. Cost: often the lowest cost option with minimal expense ratios. Best for active traders who value flexibility and cost efficiency. Mutual funds. Definition: pooled investment vehicles that may be actively or passively managed. Management style: typically actively managed, aiming to outperform the market. Trading flexibility: trades at the end-of-day price. Cost: higher fees due to active management. Best for investors seeking expert guidance or customized strategies. Summary: index funds are cost-effective for passive, long-term investing. ETFs offer flexibility and low costs for active traders. Mutual funds provide active management but come with higher fees. 1. Fidelity 500 Index Fund FXAIX. The Fidelity 500 Index Fund FXAIX is a top-tier mutual fund managed by Fidelity Investments, designed to replicate the performance of the S&P 500 index, with net assets totaling $631.62 billion and an exceptionally low expense ratio of 0.01%. FXAIX offers one of the most cost-effective ways to invest in 500 of the largest U.S. companies. The fund's current price is $209.63, with a yield of 1.20%, making it a reliable option for income-focused and growth-oriented investors alike. The fund has a year-to-date return of 28.05%, showcasing its alignment with the S&P 500's robust performance. Assuming an annual growth rate of 15% based on its 5-year average return, a $100,000 investment in FXAIX could grow significantly over time. After 10 years, the investment could reach approximately $404,000. In 20 years, it could grow to $1,636,000, and in 30 years, it may surpass $2 million, $6,629,000. These projections emphasize the power of compounding in long-term investing. For dividend income, a $100,000 investment would generate $1,200 in the first year at the current yield. Assuming a dividend growth rate of 5% annually, the annual dividend payout could increase to about $1,950 after 10 years, $3,170 after 20 years, and $5,160 after 30 years. This growing dividend income, combined with the substantial appreciation of the principal, highlights the value of FXAIX for investors aiming for consistent growth and income over time. FXAIX's low-cost, diversification, and market-matching performance make it an excellent choice for long-term wealth building. It is particularly suitable for investors seeking to minimize expenses while maximizing returns in the U.S. large-cap equity market. 2. Schwab Total Stock Market Index Fund, SWTSX. The Schwab Total Stock Market Index Fund, SWTSX, is an exceptional option for investors seeking exposure to the entire U.S. equity market, including large, mid, and small-cap stocks. With net assets of $27.51 billion and an expense ratio of 0.03%, this fund is one of the most cost-effective choices for diversifying across the U.S. market. It offers a yield of 1.10%, which provides a consistent income stream for long-term investors. The fund's beta is 1.02, indicating it closely tracks market movements with slightly higher volatility. SWTSX recorded a year-to-date return of 27.71%, showcasing its strong performance in aligning with the broader market's growth. Assuming an annual growth rate of 13% based on historical trends, a $100,000 investment in SWTSX could grow significantly over time. After 10 years, the investment could be worth approximately $339,000. In 20 years, it could grow to around $1,148,000, and after 30 years, the value could reach an estimated $3,888,000, emphasizing the power of compounding. In terms of dividends, the initial investment of $100,000 would yield $1,100 in the first year. Assuming a dividend growth rate of 5% annually, the annual dividend payout could grow to about $1,790 after 10 years, $2,920 after 20 years, and approximately $4,760 after 30 years. This increasing dividend income, coupled with the growth of the principal investment, highlights the appeal of SWTSX for investors looking for both growth and income. The Schwab Total Stock Market Index Funds. Combination of low costs, broad market exposure, and consistent returns makes it a valuable addition to a diversified portfolio, particularly for long-term investors focused on building wealth steadily and efficiently. The Fidelity Zero Total Market Index Fund, or FZROX, is a compelling choice for investors seeking broad exposure to the entire U.S. equity market, spanning large, mid, and small-cap stocks. With net assets of $25.75 billion and an expense ratio of 0.00%. This fund eliminates management fees, providing unmatched cost efficiency. The fund's yield stands at 1.06%, offering a steady income stream for its investors. Its beta of 1.02 indicates that it closely tracks the overall market with a slightly higher level of volatility. FZROX has achieved a year-to-date return of 27.74%, reflecting its alignment with the strong performance of the U.S. stock market. Assuming an annual growth rate of 13%, a $100,000 investment in FZROX could grow significantly over time. After 10 years, the investment could be worth approximately $339,000. Over 20 years, it could grow to about $1,148,000, and in 30 years, it may reach approximately $3,888,000. These calculations are based on the compound growth formula, emphasizing the potential for wealth accumulation through long-term investing. For dividend-focused investors, a $100,000 investment would generate $1,060 in dividend income in the first year, based on the current yield of 1.06%. Assuming a dividend growth rate of 5% annually, the income could rise to $1,730 after 10 years, $2,820 after 20 years, and approximately $4,590 after 30 years. These growing dividends, combined with the principal's appreciation, highlight FZROX's value for investors aiming for both growth and income. FZROX's combination of zero fees, broad market exposure, and reliable returns makes it an exceptional option for investors focused on cost efficiency and long-term wealth building. It is particularly well-suited for those looking to maximize their returns while minimizing expenses. 4. Vanguard Total International Stock Index Fund, VXUS. The Vanguard Total International Stock Index Fund ETF shares, VXUS, offers investors broad exposure to international equity markets, covering both developed and emerging economies. With net assets of $442.79 billion, this fund provides a diversified portfolio of global stocks outside the United States. The fund's current net asset value, NAV, is $59.29, and it carries a competitive expense ratio of 0.08%, ensuring cost-effective access to international markets. The fund's yield stands at 2.97%, offering consistent dividend income. Its price-to-earnings PE ratio of 14.70 highlights its valuation relative to earnings. The fund's beta of 1.03 indicates that its volatility closely tracks the broader international market, offering investors market-level performance. With a year-to-date return of 5.94%, VXUS has shown steady performance, demonstrating resilience amid varying global economic conditions. Assuming an annual growth rate of 5.94%, a $100,000 investment could grow to approximately $175,000 in 10 years, $306,000 in 20 years, and $535,000 in 30 years. These projections leverage compound growth, reflecting the potential for steady, long-term returns. For dividend-focused investors, a $100,000 investment in VXUS would yield $2,970 in annual dividends initially. Assuming a dividend growth rate of 5% per year, the annual dividend income could increase to approximately $4,840 after 10 years, $7,880 after 20 years, and $12,820 after 30 years. This growing income stream, combined with capital appreciation, highlights VXUS's potential as a reliable investment for global diversification and income generation. VXUS's combination of low costs, broad international exposure, and consistent dividend payments makes it an excellent choice for investors seeking to diversify their portfolios while capturing growth opportunities outside the U.S. It remains a valuable asset for those looking to achieve balanced, long-term investment goals. 5. Schwab S&P 500 Index Fund, SWPPX. The Schwab S&P 500 Index Fund, SWPPX, is a mutual fund managed by Charles Schwab Investment Management that tracks the performance of the S&P 500 index. With net assets totaling $111.14 billion and an exceptionally low expense ratio of 0.02%, SWPPX offers cost-effective exposure to 500 of the largest U.S. companies. Its current price is $92.68, with a yield of 1.12%, providing a blend of capital appreciation and dividend income. The fund's 5-year beta of 1.00 shows it moves in tandem with the broader market. SWPPX has a year-to-date return of 28.03%, demonstrating its alignment with the robust performance of the S&P 500. Assuming an annual growth rate of 15% based on historical trends, a $100,000 investment in SWPPX could grow significantly over time. After 10 years, the investment could reach approximately $404,000. Over 20 years, it could grow to $1,636,000, and in 30 years, it may surpass $200,000, $6,636,000. These projections emphasize the power of compounding in a long-term investment strategy. For dividend-focused investors, a $100,000 investment would generate $1,120 in the first year, based on the current yield. Assuming a dividend growth rate of 5% annually, the income could increase to approximately $1,830 after 10 years, $2,990 after 20 years, and $4,870 after 30 years. This consistent and growing income stream enhances the fund's attractiveness for long-term investors seeking both income and growth. SWPPX's low costs, strong historical returns, and market-matching performance make it a solid choice for those looking to build wealth steadily. It is particularly suited for investors seeking a hands-off approach with reliable exposure to the U.S. equity market. How to start investing in index funds. Open a brokerage account. Choose a reliable platform like Vanguard, Fidelity, or Schwab. Ensure it offers access to the index funds you're interested in. Set your investment goals. Define your financial objectives, growth, income, or diversification to guide your fund selection. Determine your budget. Decide how much to invest. Many index funds have low minimums or none, while some, like Vanguard funds, may require $3,000 or more. Research funds. Look for funds with low expense ratios, strong historical performance, and alignment with your goals, e.g., S&P 500 for U.S. stocks or international funds for global exposure. Choose your fund. Select the index fund that suits your strategy. Popular options include Vanguard S&P 500 ETF, VOO, or Fidelity Zero. Total Market Index Fund, FZROX. Start investing. Make an initial investment and consider setting up automated contributions to ensure consistent growth over time. Monitor your portfolio. Periodically review your investments to ensure they align with your goals, but avoid overreacting to short-term market fluctuations. Index funds are ideal for building long-term wealth with minimal effort. Are index funds good or bad? Index funds are great for long-term investors due to their low costs, diversification, and consistent market-matching returns. However, they only track the market, offering no outperformance or downside protection. They're ideal for beginners or passive investors, but lack flexibility for those seeking tailored strategies or active management. Index funds are a game changer for beginners and experienced investors alike. With their low fees, consistent returns, and ease of use, they're one of the smartest ways to grow wealth. Remember, investing isn't about timing the market, it's about time in the market. Which index fund are you most excited to invest in? Let us know in the comments. If you found this video helpful, give it a like, subscribe, and turn on the notification bell for more finance tips. Until next time, happy investing!